We know how to read charts and draw support and resistance. We know how to manage our risk. We know where to buy and where to sell. This may seem like this is all you need to know to be successful at trading, but I can confidently say that will only contribute to about 30% of your success. Learning the concepts and learning a strategy is easy. The hardest part is creating a successful trading mindset to become consistent, which takes some traders years to even realize or develop. My goal in this lesson is to help you be aware of the detrimental mentality that causes day traders to fail so that you can learn to avoid it and develop the right mindset early on. If you recall back in the first lesson, the reason 90% of day traders fail is because their losers are bigger than their winners. And there is a reason that this happens. Everyone starts out with a mentality that has already likely sealed their fate to fail. And this mentality isn't something that we choose to have. In fact, we probably don't even realize that we have it. It's a pre-programmed biological state of mind that has been in humans over the past thousands of years. It's just how we think when we are faced with financial pressure in real time. This mentality consists of three behaviors. Number one, focusing too much on the reward. Number two, trying too hard to predict the market. And number three, making decisions based out of fear. If you act on any of these behaviors, it doesn't matter how good you are at analyzing charts or how good your strategy is, you will not be a successful trader. And most traders don't realize that the root of all their difficulties lie within these three behaviors. And the reason that this is so difficult to realize is because of how our brains work. Our brains have two systems for making decisions. The first system, we'll call this the I system because this is driven by instinct or a learned reaction based off of prior experience. It's what makes us move our hand away if we touch something hot. It's what makes us duck from a flying object. In other words, we don't have to think to make a decision. It's just a fast, automatic, and unconscious way to make decisions. But this type of thinking can be prone to errors because it's so fast. This is also where all of our emotional responses come from. The second system, we'll call this the A system because this is an analytical way of thinking. It's driven by reason or logic. This system can make complex decisions, but it is slow and takes effort, therefore giving us more reliability. When it comes to trading and making decisions, most of us think that we are always using our A system to make our decisions. But when trading in real time under financial pressure, we use our I system more often than not. And to get this point across, I want to give you a popular 3-question cognitive reflection test designed by Shane Frederick. Now, I want you to pause the video, read the questions, and write down your answers. And try not to take more than a few minutes because when day trading in real time, you're not going to have very much time to make decisions as well. So go ahead and pause the video and I'll come back. Okay, do you have your answers? Each of these questions uses our I and A system in some way or another. The answer to question number 1 would seem to be 10 cents if our I system was more dominant, but if we were using our A system, we would find that the correct answer is going to be 5 cents. For question number 2, our first reaction is to say 100 minutes if our I system was in control. But with a little help from our A system, we would find that if it takes 5 machines 5 minutes to make 5 widgets, then the output is actually 1 widget per machine per 5 minutes. So if there were 100 machines, it would take only 5 minutes to make 100 widgets. And for question number 3, the I system would say that the answer is 24. But a little help from our A system would tell us that if the patch doubles in size every day, then the day before it covers the entire lake, it must have covered half the lake, so the answer is 47 days. Now, if you only got a few of these right, or even none at all, don't worry. When Shane Frederick first administrated this test to 3,500 people, he found that only 17% of people got all 3 questions right. Now, this test is not to see if you are smart enough to trade stocks. It's just to help you realize that a lot of trading decisions stem from our I system, even though we think we are using our A system. The I system will be where most of our trading mistakes come from, such as hesitating, changing our risk, jumping the gun, selling a winner too soon, or holding a loser too long. Even if you try to justify the reason to make these mistakes in some rational way, the origin still stems from the I system. Have you ever made a dumb mistake on a trade and you look back and you say, "What was I thinking? Why did I do that? That did not make any sense. I should have done this." That is because our A system is only dominant when we are not in a position. Once we enter into a position, or we start to get close to enter into a position, that is when our eye system starts to become more dominant, and this is where most of the mistakes happen. So by acknowledging that us humans are prone to this type of decision making under pressure, we need to put ourselves in a mindset that eliminates as much eye system thinking as possible. So let's start out with the first behavior that causes traders to fail: focusing on the reward. We all drew an interest to trade stocks for one thing: to make money, right? It seems to be a fast and easy way to be able to afford that new Maserati or quit your 9 to 5 job. Our eyes are easily fixated on the prize. That's why so many traders jump right in using real money, because they want the rewards as soon as possible. But when it comes to reward, it's something we can't really predict. We can have a good idea of where the stock may be headed, but there's no guarantees it will get there. We can't wake up every morning and say, I need to make $200 in the market today, because there's no guarantees the market will provide you with a good opportunity, yet alone $200. When you are always thinking about the reward, you are always putting focus on the unknown, and it's impossible to predict the unknown. But what we do know is how much we can risk. We can wake up every morning and say, today I want to only risk $100. If the market takes my money, so be it, because I have already accepted the amount I'm willing to lose. If I'm right and the market gives me $200, that's great. So let's say that for every trade you risk $100 to make $200. A common problem traders have is not giving their trade a chance to reach up to $200. They take their profits way too early before any indication to sell. Now, why would they do this if they are focusing on the reward? Wouldn't they be holding on to their position to get a bigger reward? That's what the A system would tell us. But once we are in a trade, our I system would tell us to quickly take $20 because maybe we are happy with $20 and we don't want to lose it. After all, a winning trade is better than a losing trade, right? Well, not necessarily. Winning trades are only good if they are bigger than our losers. If we take 5 $20 winning trades in a row, we may feel like we are excellent traders because winning feels good and we predicted a profitable outcome 5 times in a row. But all it would take is one $100 loss to wipe out all of our winning trades. By focusing on losing that small $20 reward, you are ignoring the risk of taking a big losing trade that will wipe out your gains. This is why risk-reward ratios are so important. Risk comes first, not the reward. The second behavior that will most likely cause traders to fail is believing that they can predict the market. Now, this may seem like a contradiction because how else are we going to make money if we don't try to predict what the price will do next? We do need some sort of analysis that will help us determine what the price will do next, but where most novice traders get into trouble is that they expect their analysis to be correct. I see traders all the time mismanage their risk by going all in on a stock or adjusting their risk in a position because they are expecting a certain outcome from their analysis. Maybe the chart setup is perfect. Maybe the news is spectacular. Maybe everyone in the media is predicting the same thing. But the problem is the markets have no rules or boundaries. They are completely free to do whatever they want. Just because a chart pattern is perfect or all the professional analysts are saying it's a home run does not guarantee the trade will work out in your favor. When you believe something will happen, you are also expecting it to happen. When you expect something to happen and it does the opposite of what you are expecting, it's easy to not accept that you were wrong. Because being wrong does not feel good. When you are wrong on a trade, all that hard work, all that analyzing, all that research, and all those fantasies of closing out that big winning position was for nothing. When you don't accept the reality that you were wrong, it will be extremely easy to try to come up with reasons to become right so that your hopes and expectations are not completely shattered. This is when your I system is going to start to kick in. You will be trying to come up with ways to be right. You may think it's rational to add to a losing position even though the trend has completely reversed on you. Or you may hold on to a losing position because you still believe that your first prediction will become true. Maybe you just mistimed it. This is not rational thinking. This is emotional thinking because you are not accepting you were wrong on your initial prediction. This will lead to your losses becoming huge and your winners becoming small, which will eventually lead to your account becoming zero. The rational decision in this situation is just to accept that you were wrong, take a small loss, and move on to another trade that could wipe away that small loss and possibly give you a profit. It's impossible to predict the market with certainty. All we can do is analyze the probability that our trade will work out. When we think in probabilities and not expect anything, then it will be much easier to accept that our trade just so happened to take the portion of the probability that was not in our favor. And by determining our risk beforehand, it should not be a concern if we were wrong. No matter how good you are at reading charts, no matter what combination of indicators you use, no matter how perfect the trade setup seems to be, you will never be able to predict what the markets will do every single time. There are just too many factors that you can't possibly know in order to predict the market's future. Every trade pattern will have a completely different and random outcome than the last result. Let's take the bull flag pattern that we talked about in lesson 8, for example. You identified a perfect bull flag setup holding strong support, and you bought at the perfect moment and you sold, hitting your profit goal. Now let's say a day later you identified the same bull flag pattern on the same stock at the same price, and you bought at the perfect moment, just like last time. You predict that the stock will rise to meet your profit target goal, only this time the stock drops and you sold for a loss. Why did the bull flag pattern not work out the second time? It was identical to the first. You did everything right. You waited for the right moment and bought at the best price. What happened? The pattern may be the same, but the people trading the same pattern are completely different from the last pattern. You have a completely new number of traders using different strategies, using different share sizes, and they all have different levels of experience. Every single pattern is unique because every group of traders trading that pattern is unique. This is why the market is unpredictable, because it's impossible to know the details of each group of traders looking at the same pattern. So if each pattern is unique and each outcome is completely random, how can we know if a stock will work out in our favor? The answer is to start thinking in probabilities. We can't know for sure if our trade will be a winner, but we can have an idea of the probability of what that particular pattern produces. Under the right conditions, and if traded correctly, the bull flag pattern has a win rate of about 65%. We know that if we took 100 bull flag trades, that we will win 65 times. And if we follow and stick to our risk to reward ratio of 1-to-1 or higher, then we will make money just trading the bull flag pattern. Knowing the probability and cutting our losses when we are wrong is going to be crucial to your success. This kind of logic is coming from our A system. And always reminding ourselves that if we take trades that have a probability higher than 50%, and when we are wrong, we make the loss small, and when we are right, we let the winner ride, we will keep our I system from taking over, making it much easier to accept that our wrong predictions are okay. As soon as you start trying to expect something, that is when you're going to make mistakes. It's funny because just this morning before making this video, I made a mistake of trying to predict a pullback that kept me from taking my profits when I should have. There were clear signs I should have exited the trade, but I was expecting the stock to pull back to this yellow support line, then continue higher. Now it did pull back, but instead of curling back up, it kept dropping down, causing my winning trade to become a losing trade. It was that expectation that made me hesitate on taking my profits. You need to go into every trade with no expectations. If you don't expect to win or a certain dollar amount gain on the trade, then it will be easier to exit the trade once an exit signal presents itself, and just accept whatever the market gave you. The third reason traders fail is acting on fear. Most of the mistakes you will make will come from fear-based decisions. Every time you sell a winner too soon, every time you hold a loser too long, every time you jump the gun too early, you are acting on fear, even if you try to come up with, and I'm doing air quotes here, a logical reason to make those types of decisions. I was watching a live trading recap of a trader who cut his winners extremely short in the trading session. The video was made on a day during the last week of the year, the week between Christmas and New Year's Eve. Now, for anyone new to trading, this can sometimes be a difficult week to trade because this is a week many traders take time off, thus providing low volume and high volatility in the market. But during this particular week, we had some of the best trading that year. I asked this trader why he sold his winners too soon. If he would have held on to his winners like he normally would have, then he would have had an excellent day. He responded that it was a holiday week and he wanted to reduce his risk trading during this time. I then told him to try and not let fear alter your trading plan. He then responded that he wasn't scared. He just made a calculated decision since he traded during this week in previous years. Now, think about this for a second. He made a calculated decision based on prior experience. Maybe last time he traded during this week, he took some bad losses. Maybe he made some good winning trades, but then gave them all back. So for this year, he thought the rational thing to do is to immediately take profits once he was up so he can reduce the risk of having a red day. Now, at first glance, this does seem logical, but if you take the time to think about it, this is actually an I system decision based through the emotion of fear. Why did he cut his winners too short? Based on past experience, he was afraid of giving back profits. So what's the logical decision to be made here? We previously learned that each and every trading pattern, or really each and every trading day, is completely unique. It does not matter what has happened in the past. Every trading situation is completely different. You should be taking each trade as you normally would no matter what past experience you have, because past performance does not reflect future performance. Now, I understand the reason to be concerned trading during this holiday week, so it's okay to try to reduce the risk. But the logical decision is not to cut your winners short. The logical decision is to adjust your max loss per trade to something you are comfortable with during that week. Maybe normally you risk $100 on each trade. So for this week, you can adjust your max loss to $50 per trade. You want to be adjusting your loss potential, not your reward potential. If this particular trader would have let his winning trades ride, he would have probably had the best trading week of his entire career, as this particular week provided some of the best setups out of the entire year. But because he acted on his I system, it cost him huge potential. You'll notice a lot of beginner traders make big gains started out. Maybe they made 20% or more their very first month of trading. Maybe you were one of those traders, which got you hooked onto trading. I know I was. This is common because they have no negative experiences to associate the market with, and therefore don't let fear make their decisions. Looking at this monkey in the snake picture, maybe this monkey is seeing a snake for the very first time. This monkey has no negative experience with snakes and therefore isn't afraid to get close to it. But if this snake bit him, I'm sure this monkey will never get close to another snake again, as long as he didn't die from the bite, of course. But just like our experienced trader who we previously mentioned, if he had never had that negative experience during the holiday week in prior years, I would bet that he would let those winners ride for big gains. But because of that negative experience, he adjusted his plan and cut his winners short to make sure he got a winning trade. When you are just starting out trading, you are fearless because you have no negative experience to cause you to fear anything. And the reason you make big gains is because you are fearless. But the more you trade, the more negative experiences you will have. The more negative experiences you have, the more you try to analyze and study the market to reduce as much negative experiences as possible. The more you study and analyze the market, the more you think that each decision you make is the most rational decision. When we lose on trades, that creates pain. Our brains do everything to avoid pain, so we try to think of ways to block out that pain. And we block out that pain by changing our strategy to try to become right. This is the point where most traders get stuck and never become profitable. They adjust their trading based off of past experience. Even though they think this is rational thinking, it's actually fear-based thinking. If they cut a winner too short, they do so because in the past they had a winner turn into a loser. If they held on to a loser too long, it's because in the past they sold for a loser only to see later that they would have profited if they just would have held. If they jumped the gun too early, it's because in the past they missed out on a huge opportunity. All these decisions are fear-based, no matter how rational you try to make them. Fear has no place in stock trading, and it's the number one reason why so many day traders struggle with cutting their losers quick and letting their winners run. Once you learn to not be afraid is when you will start profiting. But learning to trade without fear is no easy task. The whole reason we have an I system is to quickly act on fear. It's what protects ourselves from potential pain or danger. If someone who was standing right next to us were to suddenly, without warning, throw an object at our face, our I system would quickly tell us to duck. If we were only using our A system, we would try to rationalize before making the decision to duck. Is the object soft or fluffy, or is it hard and sharp? How hard is the object thrown? By the time we make a decision trying to rationalize, it will be too late. So our eye system is designed to make decisions instantaneous. Even if the decision was wrong to duck, it still saves us from potential pain. When trading stocks, we are surrounded by potential pain, which is why our eye system is so dominant when trading. Pain from losing on a trade, pain from giving back profits, pain from missing out on a trade. This is why successful trading is so difficult. It's because our brains are not designed to ignore fear. So, how can we eliminate fear in our trading? You just have to simply find the high probability pattern, determine and accept the risk before entering the trade, and take profit once targets are met. That's it. If you have already accepted and determined the risk and you know the statistics and the probability of the trading strategy you are using, then what is there to be afraid of? If you want to be a consistent trader, you have to realize that consistency cannot be measured in a dollar amount coming from the markets, because the markets are never consistent. There is no telling how much your winning trade will produce, or even if the market will produce the pattern you were looking for day in and day out. The only way we can find consistency is from within ourselves. If we are consistent at managing our risk and are consistent at only making A system decisions, we will become consistently profitable. Learning to control I system decisions is the hardest part about trading, and it does take a long time to master. In fact, I don't believe it's possible to completely remove I system decisions 100% of the time. They will still pop up from time to time. But by simply being aware of how your mind works and why you make the decisions you are making, you can analyze your performance much quicker and adjust what you need to turn things around much faster. On every trade you make, ask yourself, was this truly an A system decision, or was it actually an I system decision? Once you're good at analyzing these decisions, then your trading performance will start to improve. Most traders don't know it's their mindset that's causing them to lose, and instead they focus all their attention on the markets, when in fact the market is not the problem, it's the trader. And not realizing this will be a never-ending struggle that will never lead to profitability. I hope that you all learned something, and I want to thank you so much for watching.